Whitbread reported first quarter total sales of £727 million for the 13 weeks to 28 May, up 2%, with Premier Inn UK accommodation sales rising 3% and RevPAR growing 2% ahead of the wider mid-scale market. Germany delivered 16% accommodation sales growth in sterling terms as 6 new leasehold hotels opened. The forward order book, management said, was running ahead of last year in both countries. Shares fell 5% to 2,255p on the day. That is the paradox the market handed investors this week. A hotel business outperforming its sector, raising no red flags on demand, and carrying £709 million of net debt that came in better than forecast, and the stock dropped. The bottleneck is not the trading numbers. It sits inside the earnings bridge. The transition away from branded restaurants will cut FY27 revenue by £140 million to £160 million and profits by £40 million in the transition year alone, prompting Panmure Liberum to flag potential consensus profit downgrades of 15 to 20% for FY27. RevPAR growth of 2% does not paper over a deliberate £40 million profit cut. Then the peace deal arrived. The U.S.-Iran ceasefire concluded this week, and CEO Dominic-Paul noted on the June 18th earnings call that elevated airline fares had been steering UK holidaymakers toward domestic travel, and that a peace deal, by normalizing international travel, could run both ways. Peel Hunt analyst Ivor Jones wrote that the end of the Iran conflict was probably positive for Whitbread, since cheaper international airfares could redirect leisure spending abroad. Nearly 90% of Whitbread's revenue comes from the UK. The new macro environment did not resolve the activist tension, it sharpened it. Management says the business is positioned for a strong summer. Corvex Management, which holds approximately 7% of Whitbread, says the business should be sold. Corvex's public argument centers on the budget changes hitting UK businesses with rate hikes, which the fund cited as evidence of a valuation gap that management's 5-year plan cannot close from within. The fund has threatened to nominate its own directors to the Whitbread board if management refuses to launch a formal sale process. That is not a hedge fund floating an idea. It is an activist escalation with a concrete timeline. Management's counter on the June 18th call was that forward bookings justify staying the course, that Germany is now profitable at £2 million surplus, and that the 5-year plan targets £275 million of incremental profit before tax by FY31. CEO Dominic-Paul defended capital spending explicitly, rejecting the activist thesis that halting growth investment and returning cash was the superior path. The disagreement between Corvex and management is not really about the RevPAR trajectory, it is about the FY27 pain period. Panmure's own buy rating rests on the assumption that the transition costs are temporary, that by the time £50 million of one-off costs unwind and Germany scales, the FY31 earnings profile justifies today's price. Shore Capital, more cautious, said it did not expect much change to consensus estimates from Q1, implying the upgrade catalyst that would validate management's case has not yet arrived. Two analysts, same Q1 data, materially different reads on whether the current discount is a buying opportunity or a floor that has not yet been found. The reversal that most observers are missing is embedded in the 5-year plan's own numbers. The plan targets recycling £1.5 billion of freehold property, reducing the freehold proportion of the portfolio from 50%. Whitbread's balance sheet carries net debt of £709 million, below market expectations, against an estate that is roughly half freehold at current proportions. The 5-year plan's £1.5 billion recycling target is not asset stripping. It is a deliberate portfolio rebalancing toward a leasehold model that frees capital for shareholder returns. Management treats this as structurally sound. The UK commercial property market has absorbed institutional hotel transactions in recent years at reasonable valuations. Corvex's implicit arithmetic runs differently. A private buyer of Whitbread would not need to wait for Whitbread to recycle the freehold portfolio over 5 years. They could capture the freehold value on acquisition at a full property valuation premium and run the operational business against a reset cost structure. The activist demand for a sale is in effect a demand to crystallize the property value embedded in today's balance sheet, rather than distribute it through earnings over a decade. Shore Capital's 13 times price to earnings and 7 times EV/EBITDA metrics suggest the market is not awarding Whitbread a property company valuation, it is pricing it as a trading business. That gap between trading multiple and asset value is what Corvex is attacking. The hidden assumption in management's case is that the commercial property market will remain liquid and receptive to £1.5 billion of hotel freehold disposals over the plan period at valuations that support the shareholder return target. Nothing in the Q1 results tests or confirms this assumption. RevPAR growth, forward bookings, and German margin delivery are operational data points. They say nothing about the exit valuations achievable on freehold hotel assets over the next 5 years. The counter-evidence against management's plan is not operational, it is structural, and the Q1 numbers did not address it.
The Corvex threat is live and has a timeline. The fund has said it will nominate directors if the board refuses a strategic review. That is the near-term checkpoint. If Corvex escalates to a formal nomination in the coming months, a proxy fight becomes the new price-setting event, not RevPAR or forward bookings. A holder watching RevPAR data to validate their position is watching the wrong variable. The question is not whether Premier Inn is growing market share. It is whether Corvex has sufficient support among the remaining 93% of the register to force a board change. Panmure Liberum holds a buy at 3,440p, roughly 45% above the current price, on the grounds that the 5-year plan's earnings rebuild is underpriced. Corvex's implicit bid premium would need to represent a meaningful uplift on 2,377p to be compelling to a fragmented institutional register. Neither position is obviously wrong given the available evidence. That is precisely the paralysis structure. A holder cannot comfortably hold through a proxy fight without knowing whether Corvex has the votes, and a watcher cannot enter knowing whether the downside from an abandoned sale process reopens the earnings downgrade narrative. The variable that resolves this is not operational, it is governance. The holder's trigger is clear shareholder alignment. If institutions holding the remaining register publicly oppose the sale demand and back management, the 5-year plan discount narrows and the £2 billion return becomes the thesis. If institutional silence or defection gives Corvex momentum, a bid process opens and the price discovery moves to M&A premia. The watchlist candidate waits for exactly that signal before entering. A position taken before the shareholder alignment becomes legible is a governance bet, not a business bet. For now, the trade is the announcement, not the trading statement. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.